For decades, the 60-40 portfolio, 60% equities, 40% bonds, was the bedrock of wealth building. It was an elegant system for risk management. When stocks dropped, bonds held steady, keeping your capital safe from sudden shocks. Look at modern stock and bond performance. These two distinct lines, representing equities and fixed income, are now converging. Moving in lockstep, they drop simultaneously. The 60-40 model is a mathematical trap. Its promised diversification no longer exists. At the same time, the stock market has been completely retailized. Zero-fee apps and social media algorithms have turned public equities into a playground driven by daily sentiment and retail volatility, rather than underlying business value. As this fragile illusion of public market safety dissolves into sand, elite capital is taking a completely different approach. Smart money is no longer trying to trade faster or time the public markets. They're exiting the arena entirely. Every hour spent watching a daily ticker represents a choice to prioritize visibility over wealth preservation. In the modern economy, this perceived safety of public liquidity functions as a gilded cage, offering the comfort of constant monitoring while the underlying capital stagnates against the real-world performance of private assets. The real wealth in technology is no longer made by chasing the latest software app. The sophisticated money is migrating downstream, moving away from code and into heavy physical infrastructure. Everyone spent the last few years obsessing over artificial intelligence and microchips, but the actual bottleneck for global computing in 2026 isn't the processing hardware, it is the electrical grid. Hyperscale data centers require enormous, dedicated cooling and power densities to function. Private equity captures this market by combining a raw land asset with a pre-negotiated power purchase agreement. This lucks together into a highly shielded asset. Leasing to major tech companies provides triple net lease stability, while offering the high growth appreciation of AI's physical foundation. Leaving capital parked in a stagnant money market fund or a basic real estate trust carries a significant opportunity cost. Every dollar sitting idle is a dollar not working in the private infrastructure boom, where the physical layer of the internet is being rebuilt. The retreat of traditional and regional banks from mid-market corporate lending has become a permanent byproduct of the current regulatory landscape. This withdrawal has created a persistent capital vacuum that traditional institutions are no longer equipped to fill. Private credit has stepped in to fill that vacuum, specifically senior secured debt. Loans backed directly by a company's hard assets has matured into the primary mechanism for accredited investors to act as the bank. This chart illustrates the difference. Public bondholders are price takers with low fixed returns. Private lenders are price makers, commanding 10 to 14% net yields. These private loans feature floating interest rates that adjust upward, providing an automatic built-in hedge against inflation. Sophisticated investors secure their positions with hard corporate covenants and physical assets, choosing to be the lender at the top of the capital stack rather than a vulnerable shareholder at the bottom. The commercial real estate market has experienced a necessary purge. High rates systematically liquidated speculators and sponsors whose entire business models relied on cheap 3% debt and aggressive property flipping. In their wake, a new class of operationally heavy syndicators has taken control. They ignore speculative trends and focus on systemic undersupply, like industrial cold storage and build-to-rent communities. These operators create value through strict net operating income, or NOI, optimization. By intensely managing the property to increase revenue and reduce costs, they actively manufacture returns. They do not sit around hoping for the Federal Reserve to cut rates and bail out a bad entry price. True resilience in real estate today demands this kind of active operational execution. You generate strong returns by solving physical supply chain and housing shortages in the real economy. But all of these returns lead us back to the ultimate mathematical reality of wealth creation: taxes. Public market gains are inherently deceptive because they are constantly eroded by the friction of short-term capital gains and a complete lack of structural tax advantages. Look at this diagram comparing a 10% gross return in the S&P 500 against a 10% return in a private syndication. Notice how the public return block is shaved away by tax drag. The private block remains nearly whole, resulting in a 300 to 400 basis point gap in your actual take-home wealth. We call this the silent alpha. Through the strategic use of cost segregation studies and accelerated depreciation, private market investors legally shield their cash flow from ordinary income taxes. Your return scales in a way that public index funds simply cannot match. Protecting capital against this friction requires a rigorous audit for tax leaks and a focus on sponsors with deep co-investment and multi-cycle experience. Wealth preservation depends on identifying these structural efficiencies rather than simply chasing top-line percentage gains. The era of the passive 60-40 portfolio has passed. True wealth fortification requires stepping away from the daily ticker and trading the illusion of public market liquidity for the reality of protected, private returns.